Okay, hello everyone. Welcome back. Today we are going to continue with our preparation of financial statements. Right? So last week we started it. So after recording our adjusting entries and all of these deferrals and accruals, we come up with the so-called adjusted trial balance, which just gives you information on the, kind of like ending balances of all the asset accounts, liabilities accounts, equity, revenue, expense, and dividend accounts. And from the adjusted trial balance, we pull the necessary information to first create the, the income statement, then the statement of retained earnings, what we have created, then the balance sheet. Okay, so there's the fourth component missing, which is the statement of cash flows. Okay, so this is what we're going to cover today. And what we won't cover is the last financial statement component, which are the notes. Okay, but the notes, so that you know, notes just provide additional information, like more details to all of the other four financial statement components. Okay, so for example, regarding sales revenue, you would find a breakup into, for example, different segments or product segments, or into different geographical regions, and additional details. Okay, so just that you know. Okay, so the statement of cash flows. Okay, what it deals with is actually showing details to why cash has changed from one year to the next year. Okay, we can easily see that on the balance sheet. We just look at the beginning balance of cash and we look at the ending balance of cash and we see the change in cash. Okay, but that doesn't make us a lot smarter. So therefore, we prepare the statement of cash flows to add a lot of further details that are actually then very important if you plan to work in the area of finance, where this is usually the starting points for company valuation, for project valuations, and all that, right? So it's really important that you kind of like understand what's going on here. Okay, so how is the breakup of the change in cash from the beginning of the year to the end of the year? And just to say it, cash includes not only petty cash, so cash on hand, but it includes all the bank accounts as well. It even includes short-term investments into, for example, bonds that mature within the next 3 months. So this would be cash equivalents. Okay, so how do we break the net change in cash up? Well, we break it up into 3 categories. The first category is the net cash from operating activities. The second is the net cash from investing activities, and the last one is the net cash from financing activities. Okay, so we need to decide what part of the change in cash belongs to operating activities, what part investing activities, what part to financing activities. We're going to see in a moment what's behind those activities. Okay. In addition, usually what you need to come up with in the statement of cash flows, in addition, is you need to show the total amount of interest paid in cash and your cash income taxes. Okay. All right, and sometimes there's the requirement also to disclose bigger non-cash transactions. Okay, so what do we need the statement of cash flows for? Well, from the statement of cash flows, I'm able to see whether the company, is able to generate positive cash flows with their operating activities, so with their core operations. So I can immediately see, are they making any money, like real money, as of right now or not? Okay, and seems to be that, when we know whether a company is able to operate or to generate positive operating cash flows, then it helps me to project future cash flows. Okay, usually it's a very, very stable number, so it really greatly helps you to, forecast future cash flows, which you need in your valuation models. You can also see whether the company is actually able to pay it dividends and meet its obligations. Right? If you already would see that the company is spending money on their operating activities rather than earning money, then you might question whether they will be in the future able to meet their paying obligations, or pay dividends. Right? For example, we looked at Total. We've seen that they pay a great amount of money back to their shareholders in form of dividends. But the question is, can they actually afford to do so? Right? So do they actually generate enough cash so that they are able to do so? Are they borrowing money to do so? Because some companies just borrow money to pay dividends, which is not a good strategy. We can then also see the difference between the net income and the cash flow statement, speaking to all of the accounting entries that were pursued. Okay, so we kind of we can identify, okay, why, how much of the net income is driven by accounting entries as opposed to operating activities. Okay, sometimes it's the case if most of the net income is just driven by accounting entries and not by cash flows, then it tends to be overstated. Okay, so it might be an indication maybe even for earnings management. Okay, and then lastly, through the statement of cash flows, we can see how much the company is investing into its long-term investment opportunities and what it does in terms of their financing transactions. Okay, to jump, so we've got this breakdown into 3 categories, and give a little bit more understanding of what's behind those activities. Under the operating activities, what you see there, I already said it, are the core operations, the result of the core operations in terms of the net cash flows. Okay, so what you find here greatly resembles what you find in the income statement. Okay, so it deals with sales revenue that was collected in cash. It deals with payments that you do to suppliers. This is what you find here. So it closely resembles the income statement. In the investing activities, you'll find everything related to changes in investments and long-term assets. So, for example, if you buy equipment that you need to produce your goods, right? It's a long-term asset. So you would find the money that was spent on buying this equipment, you would find it as a cash outflow in the investing activity section of the statement of cash flows. Okay. If you, on the other hand, if you sell older equipment and you get cash for that, you would also find it here as a cash inflow from your investing activity. So it can go both ways, right? It can be either positive or negative. Also changes in investments. Investments could be you either buy shares of another company, to earn dividends and price appreciation maybe, or you give a loan to another company and you earn interest from it. Okay? So Total does that too. So, if they buy shares of another company, it's a cash outflow, and if they sell it, then it's a cash inflow because then they get money back. Financing activities, here you're going to find all changes related to long-term liabilities, which is, for example, borrowing money from a bank. So borrowing money from a bank is a huge cash inflow for the company, right? You increase your cash because you borrowed the money, right? And repaying the loan is a cash outflow to the firm. Both of these items, you'll find them in the financing activity section. So that's the long-term liabilities. And on the other hand, we have stockholders' equity. Okay, in stockholders' equity, what are the transactions with the shareholders that a company can do? Well, for example, it's to pay dividends. So dividend payout is a negative cash flow that you would see in the financing section of the statement of cash flows. If you issue new shares, then you get money, as a return from your new from your new shareholders, or if your existing shareholders buy more shares, then this is also usually a big cash inflow, right? So when Tesla, for example, went IPO, went public last year, right? They have issued shares. I think the amount was like 70 billion, and therefore they had a huge cash inflow in their financial statements under the financing activity section. Okay, yeah, to show you more details related to that, I'm going to close this window here. Complicated. Okay, operating activities. What you see here again, we kind of like distinguish cash inflows coming to the company and cash outflows going out of the company. Cash inflows related to operating activities are collections from customers. Okay, or receipt of interest and dividends on investments. These are my cash inflows that you would see here under operating activities. My cash outflows are if I pay the suppliers, if I pay employees, if I pay interest or taxes, or other operating cash disbursements, like, I don't know, buying and paying for supplies. Okay? So in the operating activity section, we're going to see all of these items, and then we close with the net position. We call it net operating cash flow, or cash flows used in operations sometimes. Okay, so if you compare it to the income statement, right, the operating section of the income statement, then you see that specific items are not included. And these are all items that are non-cash based. For example, depreciation, right, what we've covered last week, amortization, and as we'll see later, also gains or losses on the sale of property, plant, and equipment. Okay, because we want to move that out of the operating activity section to the investing activity section. Okay, the investing activity section, cash inflows would be, if I sell parts of my business, if I sell my long-term assets like property, plant and equipment, my land, my intangible assets. I think we've not talked about intangible assets, but intangible assets are assets without a physical substance. So something that is worth something, but you cannot touch it. So examples would be things like patents or licenses or your brand name, right? So these are intangibles, or software. Yeah, you could sell, you could invest into, you sell your computer program that you've built. Then it's a sale of intangibles and sale of investments, right? If you sell the shares that you've purchased before into the other company. Cash outflows related to the investing activities would be acquisitions of new businesses, acquisitions of property, plant, equipment, or intangibles, and the purchase of investments. Okay, so this is what we would find under the investing section. And again, then the number that we get from that is the net cash flow from investing activities, okay, or cash used in investing. Yeah. Property, plant, and equipment. It's kind of like, it's a summary of, property, like, so the buildings, a plant, like production plants, production facilities, and equipment. Okay, rather than break it into 3 accounts, you just, in general, you say it's PP&E, and everyone knows that it's kind of like physical goods that you use to manufacture, or that you use in your daily operations. So, for example, if you manufacture something, or to store your devices that you use in your service activities, or things like that. That's PP&E. Okay, then financing activities. Cash inflows would be if I issue new shares, right? Like in the case, company issues new shares, it gets money in return. It would be a cash inflow, a positive number, for positive financing cash flow. If I reissue treasury stock, okay, what's treasury stock? Treasury stock is if the company has decided to buy back shares on the market. So rather than issue new shares, they are buying back from existing shareholders. You need to show this as treasury stock. So companies do that quite often. And then if they possess the treasury stock, they sell it back on the market. Okay, so if you resell it on the market, then it's a cash inflow. And if you borrow money, of course, if you go to a bank, borrow money, it's a cash inflow for your company. Yes?
What is the difference between issuing stocks and selling stocks?
What do you mean by selling stock?
Before you show a slide, in cash inflow was yeah.
Oh, sale of investments? Yeah, so this could be shares from another company that we have acquired, and now we sell them to somebody else. And this is our own shares. The new stock is our own shares. So here we're giving, our ownership to somebody else. Whereas this is
It's not expensive to give away. It's not expensive.
what, the issuance of new shares?
Yeah.
No, it's not an expense. It's a transaction with the shareholders. So it is not recorded in the income statement. Yeah. So you would, you increase your common stock and you increase cash, and so only the balance sheet is affected. Okay. Then my cash outflows, financing activities could be that I pay dividends. That's a cash outflow. That I purchase treasury stock. So I buy shares on the market, which sometimes makes sense and it's favorable to dividends. So in some countries, dividends are taxed, but capital gains from holding shares are not taxed or are taxed at a lower rate, usually when you hold them for longer. So sometimes it's better for the shareholders not to get dividends, but to just that the company buys back their own shares and they realize capital gains. So this is why you see a lot of companies doing that. And repayment of debt. Okay, it's also what you would find in the financing activity section. Okay, right. So this is the summary. So again, we break down the change in net cash into operating, investing, and financing activities, and we show more detail to it. We really show what were the exact cash inflows, what were the exact cash outflows, and but the overall net change needs to correspond to what you see in the balance sheet. Any questions on that? Okay. Maybe as a side remark, what you can also learn from the statement of cash flows is in which life cycle stage the company currently is. Right? So for example, if you look at how the cash flow statements for a general startup looks like, usually startups, because when they begin operations, they are often not profitable yet, so they have small negative operating cash flows. However, they spend a lot of money, they invest a lot of money into future business opportunities, so you see a huge negative cash flow from investing activities here, and they finance that all through either borrowing money from a bank, but usually startup nowadays, they get money from venture capital companies or they raise it on the stock markets. Okay, so this would be how you could characterize startup company. And if the startup company moves to an early growth company, then usually it starts to become profitable. So you see positive net cash flows from operations, like you see here. You see that they're still investing a lot into business opportunities, so they expand, and that they still finance a big portion of the operation. So we still raise more money or borrow money from the bank. Okay, A mature company usually has very, very high net operating cash flows, still invests a considerable amount into business opportunities, but also now starts to repay to its shareholders in form of dividends or stock buybacks, or paying off debt. So you see that they have now negative financing cash flows. Okay, and then a company in decline usually is left only with small positive net operating cash flows. They are still investing a little bit, but not too much, and they are slowly paying their remaining debt, or they pay a small amount of dividends, right? So this is if you look at the statement of cash flows of a particular company, what you can derive. So you could derive the life cycle stage of the company. Yes.
Is it a yearly statement?
Yes, it's a yearly statement usually.
And does it always, is the net cash flow at the end always equal to zero?
Here, no, it's just for illustration purposes. I would say that probably in the startup, usually highly negative, early growth, or maybe around zero, mature, usually very positive, and decline, again around zero, right? So maybe I should change it.
What do you mean when they are between parentheses numbers?
Negative. Yeah? Parentheses, always negative number. Important, right? So, which means cash outflow, or negative, right? More cash outflows than inflows. These are all net numbers. Okay, other questions? Okay, so yeah, we're gonna actually learn how to prepare a statement of cash flows today. So there are two approaches how you can do that. One is called the direct method, and the other one is called the indirect method. Sorry. So the direct method is pretty much what I've shown you, okay, on this slide. Direct method, really, you look at the different types of transactions like collections from customers or payment to suppliers, and you show this in your statement of cash flows. Okay, this is the direct method. This is required for all of your investing cash flows that you show and all of your financing cash flows that you show. For the operating section of your statement of cash flows, however, there is an alternative method to the direct method. Okay, rather than showing your cash collection from customers, your payment to suppliers, your payment to workers, etc., you can start off with the income statement's net income, okay, and which you then adjust for everything that was recorded, which is a non-cash item. So you adjust all revenues, so you eliminate all revenues if the cash was not collected yet. You eliminate all expenses if you have not paid, for example, the suppliers yet. Okay, this is the indirect approach. Regarding the operating section, 99% of the companies use the indirect approach. Why is that? Well, because the direct method approach to operating activities is definitely more costly, right? Because here you really need to look into your bank accounts and then understand every cash inflow and cash outflow, where it comes from, what it was for, and aggregate the numbers, right? So in the past it was impossible. Now maybe you can program it maybe nicely, but still it's costly. Whereas the indirect method, you just look at the income statement, you start with net income, and then you just add back everything that you know is non-cash. So it's actually, everyone can do it, in a separate room, okay? It's very, very easy. You don't need to look on the bank account specific transactions, so it's much, much easier to do. Of course, the net cash flow from operations, whether you use the direct method or the indirect method, should be the same in the end, right? It's just a different approach of getting to the correct net cash flow from operations. Okay, so again, with the indirect method, we start with net income, then we adjust for all components that are non-cash items. What are examples for non-cash items? Well, most obviously, things like depreciation. Right? So last week we've learned depreciation expense. Right? So if we have bought equipment, what you usually do, we think about the useful life of the equipment, and then we record depreciation expense over the useful life. And the depreciation expense recording has nothing to do with the cash outflow, right? Because the cash outflow is all in the beginning when you buy the equipment. But all the other periods where we record depreciation expense, there is no cash outflow action. Okay, so what we need to do, we need to then eliminate the expense, the depreciation expense. Okay, and how do we eliminate an expense? Well, it was a negative number from the point of view of net income, so therefore to eliminate it is when we add it back to net income. Okay. Same for amortization. And we also look out for cash flows that don't belong into the operating section. Like, for example, if you sell your long-term equipment, yeah, then we also would like to eliminate it from the operating section. So if there is a gain or a loss on the sale, we need to eliminate that and then move it to the investing section. We're gonna see that in a minute. Okay, so let's start with a simple example on of how we start from the income statement and then build our operating section of the statement of cash flows under the direct method versus the indirect method. Okay, we start with a very, very simple case where you see that in the income statement, the company reports sales revenue in the amount of 100, and you get the information, all the money has been collected. So it's 100% cash. Company further reports cost of goods sold, right? So expenses follow the revenue. So this is the inventory that was shipped away at 60, and you get the information that the company in this year actually also bought 60 inventory, and it already paid in cash everything at 100%. So in terms of the income statement, the net income is 40. All right, now in the statement of cash flows, we're only interested in cash flows. Okay, these are only cash flows. Our preparation is fairly easy. So for the direct statement of cash flows, we have the first item, we call it collections from customers 100. Well, because we know sales revenue was generated of 100 and it was all collected in cash. So we can confidently write down the 100 as cash collections. We also know that cost of goods sold, all the inventory that was sold together, or that was given up together with the sale, was paid in cash. So it's a payment to suppliers of 60 that we need to record. So the net cash flow from operating activities is then also 40. Okay. For the indirect method, as said, we start with net income. So we start with whatever the income statement ends up with. So the indirect statement of cash flow starts with 40. And because it's all cash-based, there's nothing to adjust. So we're already done. So see, so that's simple. Operating cash flows, we're finished. Okay, so this is just the most easiest case. So let's move to some. The direct? That's what I'm saying. 99% choose indirect. Yeah, just much more easy. Okay, let's now bring more complexity to it. Let's just bring a little bit more complexity to it. So now the company has recorded depreciation of 10. So you see the income statement, still sales revenue 100, cost of goods sold 60, and then depreciation expense 10. So net income is not 40 anymore, but 30. Okay, what happens to the statement of cash flows regarding the direct method? Well, here nothing should change, right? Why? Because depreciation expense is not related to a cash outflow. So therefore we can simply ignore it and we stick with collections from customers and payments to suppliers, and we arrive at net operating cash flow of 40. Now, more fun part, the indirect method. Again, we start with net income. Here it's 30. Okay. But this time we have to adjust. We have to adjust for depreciation expense. Okay. And because depreciation expense was a negative number, right? It has brought our net income down from 40 to 30. In order to eliminate this depreciation expense, this non-cash item, we need to add back 10. Right? Because the negative 10 is up in here, and to eliminate that, we need to add back 10 to eliminate it. And we arrive at the net operating cash flow of still 40. Questions? Make sense to you? To add? Yeah.
Why did you put it away and then you put it back in?
Yeah. So this is the income statement. And here depreciation is a negative number. It's deducted. It's a negative number. It's deducted. But what I want to do, I want to prepare the statement of cash flows. So I want to eliminate all non-cash. So if this was a negative number in my income statement, I need to add 10 so that the net effect, so that it cancels out, right? So that it's 0.
So you need the income statement to create it.
Yes, exactly. We need the income statement to create, or details of the income statement to create the statement of cash flows. Okay, but still far more easy than looking at all the collections from customers, all the payments to suppliers. It's just looking at net income and is there depreciation? Okay, boom, add it back, right, done, finished. Yeah. Right, so you need to kind of like think about, was it deducted? Then you need to add it back. Or was it added? Then you need to deduct. Okay, we come to that, yes.
So the depreciation is kind of financing activity or
No, it's all operating. Everything's operating because it's still our kind of like core. It's our core operations. Or no, put it differently. Yeah. So it's non-cash anyway. So it's neither operating or investing. It's just eliminated like the depreciation, right? And everything related to what is depreciated is an investing activity. Right? If you buy the equipment, it's an investing activity. If you sell the equipment, it's also an investing activity. And depreciation, we eliminate. We don't want it in there. Yes. Yes.
At the beginning of the cash flow statement with the operating activities, do I have to put the gross income, like the earnings before interest, taxes?
So usually, I mean, some companies start with earnings before interest and taxes, but you can start with net income, as we do here. You can start with the bottom line of your income statement. You can start with your net income.
In the net income, do we already deduce the depreciation?
Yes. Net income is all expenses in and all revenues in, whether cash-based or non-cash based. So therefore we need these adjustments, right? Okay, now we move on to that. We get the information that regarding our sales revenue, 80 was collected in cash and 20 was not. Right? We've learned that for the accountant it doesn't matter. We record sales revenue as soon as it is earned. And we've learned that it is earned when the company has satisfied its performance obligation. Performance obligation could be to deliver the good or to provide the service. Right? As soon as they do it, they don't care about the cash, they record sales revenue immediately. But now for the statement of cash flows, it's relevant. It's relevant whether cash was collected on the sales revenue or not. Because if it was not collected yet, then we need an adjustment. Okay, but let's first prepare the statement of cash flows using the direct method. Okay, if we know that we've only collected 80 out of the 100 that we've generated in sales, then of course our collections from customers decrease from 100 to 80. Right? They were 100 before, they decreased to 80. So our operating net cash flow is just 20. Right? Gone further down. Now the indirect statement of cash flow. We start with net income of 30. We add back depreciation. And what about this this 20 in sales revenue that was not collected in cash yet. What do we need to do? Well, we need to eliminate it. Okay? It is revenue that was revenue where we have not collected the cash yet, needs to be eliminated because this is the statement of cash flows, right? We only are interested in cash inflows. So, in order to eliminate 20 in sales revenue, non-cash item, we need to deduct it. Okay, so therefore you see a negative 20 here, okay? And there's actually a rule of thumb to this. Because as you know, every time you're recording sales revenue and you're not collecting cash, it leads to an increase in your accounts receivable. Right? Every time you book sales revenue and you don't collect it in cash, it increases your accounts receivable. It's money that you get later. So that means, as a rule of thumb, every time you observe on the balance sheet an increase in accounts receivable, it gives you the information that this is related to sales revenue not yet collected in cash. So therefore, every time you see an increase in accounts receivable, it needs to be deducted in the indirect statement of cash flows to arrive at the correct net operating cash flow. So we don't only need the income statement for the statement of cash flows, but we also need to look into the balance sheet, because this is where we got the second part of the information. Okay? It's the opposite if there's a decrease in accounts receivable, right? A decrease in accounts receivable would mean you generated sales revenue, you've collected all the cash, and you've collected even more than that, probably related to sales revenue from the previous year. So a decrease of accounts receivable speaks to the fact that you've actually collected more from your customers than you show as a sales revenue. So that's why you would show like a positive adjustment to arrive at the net operating cash flow. Questions on that second item? It's important to ask because the next item is even more complicated. Yeah.
I get the 20, but I don't understand why depreciation then as a cash flow, because like that makes no sense.
No, the depreciation is not a cash flow, that's why we eliminate it.
Yeah, but you don't put it in negative brackets.
Yeah, because it's a negative number. You know, that's the whole point. In the income statement, depreciation is a negative number. That's why we need to do the opposite.
Okay, that makes sense.
Yeah, that's why it's a positive number now. It's confusing, but yeah. Why? Because net income includes sales revenue of 100, but 20 of that was not collected in cash. So 20 of that is non-cash revenue. And if you want to eliminate non-cash revenue, you need to subtract it from net income because it was a positive number. Right? So in cash terms, this 100 is overstated because you only collected 80. So that's why we need to deduct 20. That's why we're deducting 20 to arrive at the net operating cash flow. We do 30 plus 10 minus 20, and we arrive at 20. And you see the 20 is exactly the same 20 if we would just look at the real cash flows. Why we add the depreciation? So again, because it was a negative number here, it was an expense. Depreciation is an expense, so it's a negative number. So if you want to get rid of a negative number, you need to add a positive number so that it cancels out to 0. You need to do the opposite of what happened to the income statement. Right? So you start with revenue, you deduct depreciation, but if you want to add it, if you want to get rid of the position, you need to add back the depreciation. That's why it's positive. Yeah? Gonna do some, at the end of the exercise sessions, there's a big statement of cash flows that you need to prepare. After that, you should know it. Okay, any other questions related to the accounts receivable? No? Okay, so now we change another aspect. Now, now the cost of goods sold, remember we recorded 16 cost of goods sold, but now we get the information that throughout the period the company has purchased inventory 75, of which they have paid 50 immediately and 25 we decided to pay later. So what's the problem with that? Well, the problem is that the cost of goods sold that we see here, the 60, the related cash flow, which is the cash flow related to the purchase of the inventory, is only 50. So it's a smaller number. Okay, so if we want to eliminate the difference, which is 10, what we need to do is we need to add 10 to net income to arrive at the net cash flows from operations. Right? And this is what you kind of like see in the direct statement of cash flows. Collections from customers are still 80, but the payments to suppliers now shrink to 50 because you only paid 50 and not 60 because, right, although you purchased 75, you only paid 50 and 25 is accounts payable. Okay, so direct statement of cash flows is now showing operating net cash flow of 30, and in the indirect statement of cash flows, we still add back depreciation, we subtract the non-cash sales revenue of 20, and now we adjust, we have another adjustment in that we add another 10. I'm going to go into details here why this is separated into two numbers, but in fact what we're doing, we are adding back 10 of the expenses that we had under cost of goods sold because, only 50 was related to cash and 10 was non-cash that was recorded as an expense. Okay. The reason why the adding back of 10 comes with two entries is that, again, because we use a rule of thumb. And the rule of thumb, like with accounts receivable, is that every time a non-cash asset increases, okay, it needs to be deducted as an adjusting entry to arrive at the net operating cash flow. So it's like accounts receivable. You've purchased something, but you've not yet collected the cash. Okay? That's why we subtract 15 inventory. And with liabilities, it's actually the reverse. So every time liabilities increase, you see an increase in liabilities, it means that you had an expense for which you decided to pay later. Okay, and so this leads to adding back expenses in the amount of 25. Okay, and the difference of the negative 15 and the positive 25 is the 10 of adjustments that I need to correct for the cost of goods sold related to the inventory where there was no payment involved. Questions? All right, so now this is a little bit more complex. So start with the obvious, or start with the big picture. There's cost of goods sold of 60, but the company in this period only paid 50 for inventory. So there's this 10 you need to adjust. Okay, this is the big picture. Okay, and you can do that without thinking about it if you just apply the general rule. Every time you see an increase in your non-cash current assets, you subtract that increase. And every time you see an increase on the liabilities, usually current liabilities, you add it back. And the result will correspond to where you want to go. Okay, so the difference of the 25 and the 15 is again the 10. Okay, so I've got one more adjustment here. And it relates to the following. The company has sold something. It has sold some of its property, plant, and equipment. Okay, let's say they have sold equipment for 75. Okay, but at the date of the sale, on the balance sheet, it was said that the equipment is worth 70. So they have sold it for 5 more than what they've showed it in the books. Okay, so how an accountant would record this is, of course, first an increase in cash of 75, a decrease in the equipment of 70, and then there's the difference of 5. What's the difference in 5? Well, it's the gain, right? You've increased your equity just by selling it at the higher price that you showed it previously. So this is what the accountant then has recorded as a gain on sale of PP&E in the amount of 5. Okay. Okay. So this is an example for something which should be eliminated, not because it's a non-cash item, because actually it is a cash item, it's 75 that we got from it, but because it belongs to a different section. It belongs to the investing activity section and not to the operating activity section. Okay, so what we want to do, if we prepare, for example, the indirect statement of cash flows, in addition to adding back depreciation, we need to subtract the gain, because we want to eliminate it from the operating cash flow activities. And we arrive at an operating cash flow of 40. And then we show the entire proceeds, so the 75 that we've collected on the sale, as part of our investing activities. Right? So we see it kind of like in the next section of the statement of cash flows. Questions? Okay, so we can look at the statement of cash flows of Total. Okay, so they use the indirect method for the operating activities. So they start with the consolidated net income, as you can see here. They start with that 10 billion that they have earned as a net income. Then the next position is depreciation, which means they add back depreciation, 10 billion. Okay? Then they add back increases in liabilities, 469 million. They get rid of gains on disposal of assets. They get rid of earnings generated by their subsidiaries, so by the companies of which they own shares of. And so these are examples for entries that we don't want to show in the operating activity section, but we want to move to the investing section. Then they apply rule of thumb. Kind of like I told you that every time you see an increase in the current assets, you should subtract it as an adjustment entry, and if you see an increase in the current liabilities, you should add it back. It's just a rule of thumb. Okay, you just stick to that. You don't even need to understand what's going on. But what they do here is they have subtracted 5.6 billion because there was an increase in working capital. Okay, and working capital, just that you get a definition, working capital, is current assets, which includes things like accounts receivable, inventory, etc., minus current liabilities, which includes accounts payable, salary payable to employees, and tax payable. And so an increase is deducted, like an increase in assets, right? So they also apply this rule of thumb to arrive at their cash flow from operating activities, 14 billion. Okay, so what the number tells you, 14 billion, just by running them corporations, they had a positive cash inflow over the recent 12 months or 9 months here of 14 billion. Okay, so they have a lot of money to spend. They have 14 billion to spend. Okay, so the other sections provide us with information on what they have spent the 14 billions on. Okay. So the next section is the cash flow used in investing activities. So what they did is they have bought intangible assets, so for example, software, things like that. They have bought property, they have bought plants, they have bought equipment in the amount of 12.5 billion. They have bought other companies called subsidiaries for 3.4 billion. They have bought shares of other companies, and they have also lended out money to other companies. So that's a total spendings of 17 billion in the investing section, but they've also sold some of their long-term assets. So they have sold parts of their intangible assets, PP&E and so on. That's a positive cash inflow of 4.7 billion, so that the cash flows used in investing activities net is roughly 12 billion. Right? So out of this 14 billion that they have generated for running the operations, they have reinvested 12 billion into their business. So they are left with 2 billion only. Right? So what do they do with the remaining 2 billion? Well, we look into the cash flow used in financing activities. So what we see here is first that they pay dividends to the shareholders in the amount of 4.2 billion already. It's already more that they have left, right? They're also buying back their own shares. So you see it here under treasury shares. They have bought another 2.5 billion. So in total, that's 6.7 billion they are giving back to their shareholders, although they only have 2 billion left. Yeah. So it means that they are decreasing their cash balance pretty much by doing that, right? To give back money to their shareholders. Besides that, they are also repaying, debt. It's pretty much what you see is kind of like repayment of debt. So in total, they pay back 9 billion. Okay, so more that they have after operating activities minus capital expenditures. That's a decrease of 7 billion in cash that they have. Right, so they're, kind of like liquidating their cash and give back to the shareholders. Probably because maybe they don't have enough opportunities to invest into. Right, it's a very, very mature company. Right, so you see this after the cash flow used in financing activities, you actually see a position called net increase in cash and cash equivalents, which is the sum of the three items that I just talked about, the 14 billion positive net operating cash flow, then the negative 12 billion investing cash flow minus the negative 9 billion financing cash flow. That's difference of all the sum of all that, it's 7.2 billion, and which corresponds to the change in cash from the beginning of the year at 33 billion to the end of the year of 25 billion, right? So we still have 25 billion just in cash, probably to be spent and distributed as dividends in future years. Do you have questions on that? Okay. All right. Yeah, so that's pretty much it for the statement of cash flows. As said, the exercise case at the very end, I think it's question number 5, asks you to prepare a statement of cash flows, right? So you would start with net income and you would add back depreciation and look out for increases in accounts receivable, deduct that, look out for increases in accounts payable, for example, add that back, and then moving items that don't belong to the operating activity section to the investing section, right? You would prepare the whole thing, and I think it's a very good exercise. Okay, so after, however, we are done with the preparation of all of the 4 different components of financial statements, plus the notes, so 5. What is left to do is actually to close the accounts. Okay, what closing the accounts means and refers to is mainly that we want to bring down the credit balances of our revenue accounts to 0. We want to bring down the debit balances of our expenses and dividend accounts to 0 to start a new period at 0, right? If we wouldn't do that, then we would start with the revenue generated in the previous year. But if it, as soon as we hit January, revenue should be restated down to 0. So this ending credit balance, for example, needs to go. Right? That's why we call all revenues accounts, all expense accounts, and the dividend account to be a temporary account, because these accounts are closed at the end of the period. All the other accounts, like assets, liabilities, and equity, these are permanent accounts because they are not closed at the end of the period. Okay, so what does closing mean? Closing means the following. Maybe we just jump to the real numbers. So closing means that we have different revenue accounts and we have different expense accounts. These are all temporary accounts which needs to be closed. And we have dividends down here. So at the end of the year, what these accounts show us is, for service revenue, usually it has an ending credit balance. So in this case, it's 10,600, right? So they have here, the company has generated service revenue of 10,000 and then 400 and then 200. So in total, 10,600, that's the closing ending balance, credit balance, okay? To provide the closing entry means to bring the revenue, service revenue account down to zero. So how do I do that? Well, I need to make a debit entry in the same amount. So that's why you see the first entry here, the first closing entry here, debit entry of 10,600 to the service revenue. So that the balance is zero now. Okay? Every debit entry comes with a credit entry, so the credit entry goes to what we call income summary account. That's what you see here. So there's an increase of 10,600 in the income summary account. We come to that account later. Now we close all of the expense accounts. You see, we have different kinds of, or different types of expenses like suppliers expense, depreciation expense, insurance, salaries, rent, and interest. They all have debit balances, right? 1,500 here, 40, 50, 5,200, 950. They all have debit balances, like it's normal with expense accounts, right? In order to close the accounts, we need to do a credit entry to it. So we credit supplies expense 1,500, depreciation expense by 40, insurance expense 50, salaries and wages expense 5,200, then 950. The total amount of that credit entries is 7,740. And this is what we put in as a debit entry into our income summary account. Okay? So the income summary account has a credit entry of 10,600 and a debit entry of 7,740. So currently has a credit balance, okay, which now also needs to be closed. There's a credit balance of 2,860. Okay, in order to get rid of the credit balance, we do a debit entry to the income summary account, and thereby we transfer the net income, so to speak, from the income summary account to retained earnings, where it belongs at the end of the period. Remember when I said every time you generate revenues and expenses, it increases your retained earnings and it increases your equity? Well, it's because of this closing entries. Because we close revenues and expense accounts into the income summary account and then into retained earnings. Retained earnings, if this is a profit, retained earnings gets increased, okay, and then therefore has a higher balance at the end of the period than in the beginning. With dividends is a separate account, usually has an ending debit balance, so works like expenses, although it's not an expense. So a closing entry would mean a credit entry to dividends and a debit entry to retained earnings. Because when a company decides to pay dividends, it's a distribution of earnings from the past, so therefore retained earnings has to become lower. Has to become reduced. Yeah, has to be reduced. I got it. Okay. Questions on the closing entries. Here, kind of like you see how it looks like in the general journal. So you would find at the very end the closing entries, and you kind of like see how revenues transferred to the income summary account, expenses, ending balances get transferred to the income summary account, and then the income summary accounts gets closed into retained earnings, and dividends also gets closed into retained earnings. And now we can start a new accounting period, because what we have after closing the temporary accounts is we have a trial balance with only asset, liability and equity accounts, right? Because all other accounts are zero. So now we can actually start a new period and then start to record revenue again. Do you have questions? No? Okay. Then what I probably do now is do the attendance recording. Let's just do it quickly. Give you some time to. I give you some time to get your cell phone out. Yeah, and just some again recommendation. I mean, if you feel you struggle, we have this online textbook, right? You can click on online textbook and it brings you to VL ebooks. You can log in with your ESCP account and then you have access to this book, right? And for our first part, financial accounting, the first 4 chapters are relevant. Okay, highly relevant. The first 4 chapters. I've already given you brief exercises that you can do on the first 2 chapters, and I will provide you with more recommendation of questions that you should pursue this week and then next week as a preparation for the exam, right? So next week I'm going to talk about reporting structure. So we're going to learn about how we call the different items, and we'll also spend some time discussing what is potentially on the exam. Yeah, next week, because we have another session where we have time. Okay, so here, this is my recommendation. If you struggle, read the first 4 chapters, right? So studying is also about reading a little bit. So please do that. And now we take attendance, okay?